how would you recommend someone go out and find kind of different deals or different partners or syndicators?
One of the most important things is track record. Primarily for me, I want to know I can trust these guys. I want to know their track record. I want to know that they're fun to work with. This life is too short to deal with people who aren't fun to work with. This is a business. This is a wealth building strategy. But we can also have a lot of fun doing it, build strong relationships, and enjoy what we're doing at the same time. And that's what I'm about. Like, it just makes life more fun when you deal with good people.
Hey there, welcome to another episode. My name is Pascal Wagner, the host of the Grow Your Cashflow Podcast. If you're new here, we help accredited investors grow and diversify their monthly cash flow through low-risk private placements. To be clear, we're not financial advisors providing you on advice on your specific situation, but our email list, our social content, and this podcast are all designed to help you learn how to find and vet passive income opportunities so that someday when you're looking to grow your cash flow, that you'll consider working with us. And even if you never invest with us here, at the very least, we want to help you accelerate your ability to gain financial freedom. So with that, let's dive in. Today on the show, I have Dave Zook from Pennsylvania. Dave is the founder and CEO at The Real Asset Investor, which is a wealth management firm headquartered in Atglen, Pennsylvania, specializing in diverse income-generating assets, including car washes, ATMs, self-storage, and natural gas investments. His strategy is to provide investors with income and tax investment opportunities that stand out in a world of financial noise. Since founding in March of 2015, the Real Asset Investor has managed over $750 million across 25 different funds with a minimum check size of $50,000. They're known for their syndications and funds that go full cycle, providing their investors with reliable returns. He's been actively involved in the multifamily space and resort community development with real estate holdings in multiple states and even overseas. He's syndicated $25 million worth of real estate personally in his career. And notably, Dave and his development partners are pioneering early stage planning and development of the largest real estate development on the island of Ambergris, Caia, Belize, which was rated the #1 island in the world by TripAdvisor. Dave is also a published author and has been a guest speaker at the International Business Conference and on the Real Estate Radio Guys show. He, along with his wife, Susan, and 4 children, call Lancaster County, Pennsylvania, home. With that, let's hop into the show. Hey, Dave, welcome to the show. I'm incredibly excited to have you here. And, whether Dave knows it or not, he's actually been a big influence on helping me in my career path. And I originally invested with him with the ATM investment. I invested $104,000 with him in a syndication deal that he was doing. And that's been going along well. And overall, I flew out to go spend time with him and a bunch of other investors where we toured some self-storage properties and some car wash facilities together. And so I've met and known David for maybe a year or two now, and I've met him a couple times, and has absolutely been an inspiration to me. So I am excited to have him here on the show. So to get us into what we're going to talk about today, I think it's important to understand the different types of roles and people that you interact with in the world of investing. When you get into this world, there's a whole new lingo to learn and concepts to understand. There's CPAs, financial advisors, fund managers, sponsors, and syndicators, and the list goes on. And if you're new, it's kind of overwhelming. So in this episode, I'd love to cover what is a syndicator and why do you need one as part of your investing roster? How to use syndicators to achieve financial freedom at least 2 times as fast than you can on your own. And then kind of an inside look into how syndicators pick the funds that they present to investors. So Dave, for our listeners out there who don't know about you, your business, your background. Can you tell us who you are and what you do?
Well, thanks for having me on your show, Pascal. This is going to be fun. I was looking forward to it. But so I was born I was very fortunate to be born into an entrepreneurial, business-friendly family, and I was raised in the modular building space. And I sort of grew up in that business and really went through all different facets of the business. So I got into the office, and during my late teens, early 20s, I saw my dad, actually from the time I was a kid, I saw my dad take the money that he was earning from his business. He did very well. He would take the money that he earned from his business and he would invest it in real estate. And he would buy farms and land and single family homes. And I watched him self-manage some of those single family homes. I just quickly decided that wasn't going to be me. So I made the intentional decision that I wasn't going to be a real estate investor at all. And I went down the business path and I started a couple businesses, got the businesses up to the point where they were running very well and I was making a lot of money. Got myself in a position where I was paying $500,000 a year in tax. And I just, got tired of that and started doing some research and going down the rabbit hole and trying to figure out, okay, how do I keep the money that I earn? And then the further I got down that rabbit hole, the more I started to realize that people were using real estate to offset their tax liabilities legally and keep themselves tax efficient. So that really intrigued me. And so I got into the multifamily apartment space and started learning key words like cost segregation study, the bonus depreciation, and really started wrapping my mind around it. Went from paying $500,000 a year in tax one year to zero the next. And I've been living tax efficient every year since. And this is, going back more than a decade. And so it changed my life. So that's how I became a real estate investor. It wasn't like I started out when I was a kid thinking I was going to be one. It was actually quite the opposite. But here we are today. When I figured out that, real estate could keep me tax efficient, I went from not wanting any to wanting, all of it.
Yeah. Yeah. So how would you define what you do today?
Today, we run a fund management company, and we have several core asset classes. And really, this is going to sound quite selfish, but it starts with me and my portfolio. Like the asset classes, and we have four different ones, four core asset classes that we really invest in, and those that's just simply a reflection of my portfolio. So I like to invest with teams and operations teams and people who have sort of their one thing. I consider myself a sort of a serial investor, a serial business owner, own several companies and invest in a lot of different stuff. But my operations team, I want them to have their one thing. I'll give you an example. When I started investing in self-storage, I found one of the best operators. I found one of the best operators in that asset class. And, really sat down with the principals and really started asking a lot of questions. And one of the things that I asked the principal was, and he's, in his late 60s, early 70s. And I asked him, I said, what else do you invest in? And he looked at me like, what are you talking about? Like, I've only ever invested in self-storage for the last, 50 years. And, so that was the only business he's ever had. That was the only thing he's ever invested in was self-storage. He is all in. He's got one thing that he's really good at. And that's the kind of thing that I like as a serial entrepreneur and a serial investor. I like to have those guys who really know they're the masters of that asset class. Right now, we've got 4 self-storage, car wash, ATMs, and natural gas. And, I feel like we have that in each one of those asset classes. So it's really just a reflection of my own portfolio. When I find an operator that I can scale with, I'll give you another example. ATMs. I was an ATM investor for almost 4 years until I became a partner in the business and took it out to my investor base. And so oftentimes that's sort of what I do. I invest with my own money first, and then I find an operations team, really kind of nail it down and find an operations team that I believe in, then I take it out to my investor base. So we're fund managers.
I love that. What are the problems that your target avatar has, like your LPs, your investors, people who invest with you? What problems do they have before they come to you?
Well, oftentimes, so there's no real one answer. And, that's many times that's what we do when we sit down and talk to an investor. We try to find out, okay, what is your story? Because if you have an investor who has a serious tax problem, or let's say you had a liquidity event, or, he's got a tax problem and he's not, he's okay on the cash flow side. He just wants to build wealth, and he wants to stay tax efficient. And so when you have somebody like that, you may not take him down the self-storage route, because we run a value add shop on the self-storage side, which, it's a pretty modest cash flow play. We're spending money. We're fixing these things up. We're adding square footage. We're really getting them to the point where we can, package them and sell them to a REIT. So not a ton of cash flow during the hold. Not a ton of tax impact during the hold. But you're really investing for some huge equity appreciation potential. And we've had some of that. We rolled up a 26 property portfolio almost 2 years ago, which was a very lucrative deal. But we make most of our money on that deal. We make most of our money on the back end. That's totally different when you're looking at an ATM investment. Let's say somebody had a liquidity event. They made, a couple $100,000 and they're going to get taxed. Well, what can you do about that? Well, you can invest in another asset class that gives you huge amounts of depreciation. You can take that depreciation and wipe out the tax liability on your liquidity event. Or, so every investor has a different story. You just got to find out what that story is and figure out how you can add the max amount of value to that specific investor.
Understood. So how do these people that you work with solve these problems today without you? Like, what are the things that they've tried and just come up short, or maybe they just want to diversify into other things and they come to you?
Well, the conventional route is, obviously mutual funds and Wall Street and, those kind of assets. Well, those kind of, paper assets, you can call them assets. But oftentimes you got somebody that comes and they've tried that for the last 5, 8, 10 years, and they want to diversify outside of that. There's also oftentimes a lot of investors I work with are business owners. Their whole career or life has been around, it's been around building their own business. Now they got to the point where they got cash. They've been running this business for 20 years. They're plateauing on their business. They really don't have the energy or the desire to take that thing to the next level. They're really in a comfortable position. The business could be churning cash, really giving them a lot of cash flow and building a lot of wealth with them. Now they're looking, okay, how can I maximize that? How can I continue to build wealth, but do a little bit more on the passive side, make money while I sleep and not have to worry about it? And, if you can wrap that tax impact around it and really get them to the point where you can say, okay, I not only want to make cash flow on this asset, but I want to get myself in a position where I'm more tax efficient. That's oftentimes the investor I'm working with.
That totally makes sense. I feel like as though, there are a lot of different ways that you can try this, especially if you're looking for passive income. I think, I've learned from my dad, dividend investing in the stock market, and you could collect dividends. But, some of the lessons learned there is that if the stock goes down by, 20% and it's only generating 8%, it's not like a huge return. You're losing money in a lot of those instances. So I feel like that story resonates a lot. And I also think it's probably because as you grow up, as you get put into society, and you might work at a job and they offer a 401k or an IRA, typically like the default place where you invest those things are the stock market. So that's where you get used to those. And you don't know that all these other kind of investment opportunities that we're talking about here exist.
Yeah, and I have a quote that I trademarked. It is, you can be conventional or you can be wealthy, pick one. You could swap out the word wealthy with whatever, successful or a couple other words, but really when you look at society and you think about conventional wisdom, whether it's conventional wealth building or conventional health or conventional education, or you personally, I don't want me or any of my kids to be on the conventional side. I just think, you're either going to be conventional or you're going to be successful or wealthy, but you got to pick one. And so that's also how I look at, the conventional wealth building standard that's in our country. It's all about Wall Street. It's, we're trained to think that, if we work really hard for 40 years in some cubicle, then at some point, we might be able to afford to live the life that we really want when we're 65. I guess that could work for some people. It's just not for me. And, that's been sort of that conventional thought is work really hard, save your money, invest in stocks, bonds, mutual funds. And at some point you can live the life that you want to live. And it just doesn't work for me.
Now that we've kind of covered all of those pieces, I love that point. I'm on the same wavelength of like, look, if you want to see high returns or just be successful, you have to do things that other people are not doing. Be contrarian, and stock market investing is the public market. That's where everyone goes, and so not to say wealth can't be built there, but it's everyone's playing in that sandbox. So I definitely agree with that one. Changing gears to the kind of next section here. First we talked a little bit about what is a syndicator and why does someone add them? Like, what problems are they experiencing before they talk to someone like yourself? Now let's talk about how do you use syndicators to like jump ahead in your financial journey. So what are benefits of working with someone like you?
So I will give you some benefits, and you got to understand, I'm on both sides of the table here. Like I invest as an LP in other people's deals as well, because I also like the idea that I can invest in somebody else's expertise, where they're out there putting in the sweat equity and they're making this deal happen, and they're laying awake at night having to worry about labor and supply chain issues and, whatever. I mean, it's an active business. So I'm very much intrigued with being an LP in somebody else's deals, because I know when you're the syndicator, you're the GP, it's not just, somebody's got to make the stuff happen. Somebody's going to be boots on the ground. Somebody's going to be, hovering over this thing, making sure, taking care of problems, fixing things and all that. So for that, the syndicator or the GP, many times both, but the syndicator is working, and oftentimes it's, somewhat fee-based. It could be a profit split. There's all kinds of, there's all kinds of ways to structure a deal. What I like to see when I'm investing in somebody else's deal, I like to see a deal that's not fee laden on the front end. I like to see a deal where the sponsor makes money after I make money. After I get my principal back, or there's preferred return and there's a split on the back end, whatever. But I'm very into the details when it comes to, okay, I want to see how the deal is structured, because if it's structured where it's all front end loaded, where the guy makes his money, and then, it's pretty easy to see what the manager has in mind when you can kind of look at how the deal is structured. And if it's back end loaded and he makes money when you make money, that's how I like the deal. And that's really how we structure our deals for our investors. It's like, look, we either all win or nobody wins.
Yeah. I mean, a common theme that I've been hearing over and over, and I've even had on this podcast, is this concept of fund managers doing deals so that they can collect the fees to keep the lights on. And it's what's your take on that?
Well, and some industries are known for that. When they go out and do a capital raise, a couple $1 million capital raise, and you really, one of the big questions for me is, okay, how are you going to spend my money? If this is to keep the lights on and pay the manager's salaries and make sure the bonuses get paid out, whatever, not so much. But if we're going to go out and create something and we're going to go out and buy equipment and we're going to really make something happen with it, okay, that's a different story. So that is all things you should be looking at as an LP investor, as a limited partner coming into a syndicator deal. Is like, how is this deal structured? Is the manager making all of his money on the front end, or is he making the money behind you? After you make the money, then there's a split, or is there a preferred return? That's the kind of stuff I'm looking for when I'm coming into somebody else's deal as an LP.
So one of the benefits, I guess, at least in your case, or the things that you look for, is that you're always looking for something that is, when the investor wins, that's when the person putting together the deal wins. I also imagine other benefits include just getting access to deals that they wouldn't otherwise have access to. Can you think of other benefits?
Yeah, so we put a fund together for a group who their minimum investment is $1 million. Well, in our network, where we've got several thousand investors in our database, that cuts a lot of people out of play. When you got to come up with a minimum of $1 million. So there's instances like that where it's mainly geared around family offices and bigger institutional size investors, where we can come in and say, okay, we will do that deal and we will bring you $1 million, but we'll do it in a syndicated effort on our side. So those are some deals sometimes where you can't even get access to them unless you want to play with $1 million.
Totally. Yeah, we're doing something similar for the first fund here at Grow Your Cashflow. It's and I definitely see it. There's just having access to institutional style deals that might be safer, or that there's just like a certain quality of operator behind it. I'm finding that in this space, there's a lot of indie fundraisers, I guess you would call them, like people that are doing their first or second deal, and by all means, everyone has to do their first deal at some point in order to move forward. I just think as an investor, I want to be putting my money into these types of opportunities where things have been proven. There's more of a track record, and I honestly think that those are kind of deals that are better to get into if you're new to this landscape. Thoughts?
Yeah, and it does when you've got an institutional operator on the other side. And now you're coming in. I mean, obviously, you still got to do your diligence. Just because he's an institutional operator doesn't mean the deal is good always.
Totally.
So but it does give you when you come in with scale and you can team up with. I mean, it's no different than our operations team on, let's say, the self storage side, or we get a better deal because we come in with volume, and we're able to buy bigger, more lucrative deals. When we can, especially with our business model, where our whole business model is set up to where we add value to let's say we buy from a mom and pop operator, then we add square footage, climate controlled square footage, and then we roll up a bunch of these properties into a deal and get some crazy low cap rate from an institutional buyer. You can't do that. Most individuals can't play at that kind of scale, and that they can't play that game. But when you group it together, you can do it together. You might be able to pool 50 or 100 investors together and make that deal happen. So that's the advantage to being able to come in with a syndicated effort and do those kind of deals. And look, this isn't the only way. That's not the only way you can play. And obviously, you can go out and do it yourself if that's what you choose to do. And again, it has to do with how active you want to be in the space. Like, if you want to go out and buy a self-storage facility and run that business yourself, there may be more margin. There most likely will be more margin in there for you. But, there's also a lot more work, a lot more effort. And, for myself personally, I believe I could assemble a team and done my own self-storage facilities and went out and really made it happen. I chose to take a shortcut and really team up with an operations team that had been doing it for the last 50 years. So more than one way to do it. This is the way I chose to do it, and it's worked out very well for us.
So let's say someone's new to this game. They've maybe done an LP investment or two, and they're listening to this show, and they now know about the real asset investor. How would you recommend someone go out and find kind of different deals or different partners or syndicators to get on their lists, to start seeing their opportunities? And what are you looking for?
Well, so a couple things. One of the most important things is track record. I want to know, number one, I want to know that they're reputable, trustworthy guys. I want to know what they've been up to in the last 10 years for sure. Longer is better. 20 years is better. But, our community is a pretty small community. And so when you ask around, if you're plugged into the investment community and you start asking around, it doesn't take long to figure out who the key players are in any given asset class, who the star players are. And oftentimes it's better to talk to the investor than it is to talk to the operator. I'm not as much interested in the slick salesperson who can tell them that can tell me all the good things about himself and his company and what they do and what they can deliver and all that. I'm much more interested in talking to an investor that's been investing with them for the last 5, 10, 20 years. So, there's a lot of things, but, primarily for me, I want to know I can trust these guys. I want to know their track record. I want to know that they're fun to work with. Look, this life is too short to deal with people who aren't fun to work with. This is a business. This is a wealth building strategy, but we can also have a lot of fun doing it, build strong relationships and enjoy what we're doing at the same time. And that's what I'm about. Like I have the luxury now to figure out to pick people who I like doing business with and do business with them. And, it just makes life more fun when you deal with good people.
Totally. You don't get caught up in all the bullshit, to be honest. But cool. No, I dig that. So what kind of groups are you talking about, right? So I'm picture the first time investor here, and they're new to the scene, and they're trying to figure out, like, where do I go? What websites do I visit? I'm thinking there's groups like the 506 Investors Group. I've heard of Left Field Investors. I've heard of White Coat Investor if you're a physician or anything like that. And those are kind of small communities. We're now building a community here at Grow Your Cashflow to kind of help people start looking at deals and seeing everything. Are there other places that you recommend checking out?
Well, the very first one should be therealassetinvestor.com. No, no, listen, I know about most of those groups that you mentioned. And, my thought is, so before you invest for your portfolio, you should invest in yourself. And investing in yourself can include going to some of those events live. It can include investing time into, hey, let's hear about what the investors are saying on 506 or on Left Field Investor. And I know some of the guys in those groups well. So that is part of it. That's part of investing in yourselves, going on those websites, educating yourself, talking to people, getting on the forums, hearing what other people are saying about, different operators, all part of it. So no, I love it. It can start with going to a local real estate meetup. There's one within an hour of just about any. Maybe not.
Not in Columbia, South Carolina, Dave.
All right. Well, there are investor meetups all over the country. And, so that's a place to start. But also the forums that you mentioned. Great place to get information, great place, great way to invest in yourself.
Yeah, I mean, I'd probably just tag on to that. There's so much that you pick up just by being in some of these groups, text threads, understanding what people look for, what they like about a deal, what people don't like about a deal. One of the things that I like to do when I'm, looking for any of kind of investment, or as I even just got started, is you don't know what to look for or what risks are present. And so hearing the reasons why a lot of other people are not investing, and then taking that information and critically thinking, okay, do I agree with that statement, or have I found data that refutes this angle, or are approaches that I've found have really worked for me in my journey, and that I've been able to pick up being in these groups.
No, I agree. Invest in yourself first before you invest in the asset class.
Yeah, it's like anything in life, right? You got to kind of know how the game is played before playing the game if you really want to win.
100%.
That's I'm going to quote that one. That's a trademark that I did myself right there.
There we go.
Sweet. So, Dave, to kind of one of the last kind of sections I want to cover here with you is this is an inside look into how syndicators pick the funds that they present to their investors. So you've raised over, if I'm accurate, over 25 different funds or somewhere in that ballpark. What have you learned about your target customer and how to match offerings to them?
Yeah, so I don't know what that number is, but it's somewhere around 25. But many of those were sort of, it wasn't 25 different asset classes. Back in the day, we used to do a self-storage facility as a fund. Today, we can, typically we'll have 10 to 15 institutional grade self-storage facilities in a fund, but back in the day when, one property, one fund, those start adding up pretty quickly. Today, we have 4 different asset classes, and I really have no desire to have 8. I want to go deeper and not wider. I want to pick out star players in the asset classes that I'm interested in, and I want to go deep with them and do a lot of business with them. And each one of those, for me personally, in my portfolio, I have a specific reason I want that asset class in my portfolio. It could be for long-term equity growth. It could be for, to help me stay tax efficient. When you have an asset class that gives you, 80% bonus depreciation in year one, that's kind of a big deal when you're trying to stay tax efficient. So each one of those asset classes does a different thing in my portfolio for a different reason. And so once I take care of myself, you hear the thing about put your own oxygen mask on first, and you can help other people. But that's really kind of the way that I take the approach on investing is, make sure that asset class works, make sure that it does what you want it to do for you, and then go help others.
That makes sense. That totally makes sense. So essentially, you're attracting investors who are interested in the same types of things you are. Is probably how we would frame it. Yeah,
I mean, so there's, like I shared early in the conversation, somebody may have I get into these conversations all the time about, hey, I'm selling my business and I'm going to have, $500,000 in profits, or I'm selling my business, I'm going to have $10 million in profits. I mean, I've had many of those. And our investors range, I mean, we do have some family office folks. We have some institutional grade investors in our, that invest with us. But many of them are just regular mom and pop, operators, have run very successful businesses, contractors, you name them, doctors, lawyers, CPAs. There is a dentist who has his own practice who makes, $1 million a year. And then there's an attorney who works for someone at a W-2 job and makes, $750,000 a year, $1 million, whatever. And so that's very different than when somebody comes to me and says, hey, I sold my business. It was, I was active in this business, sold the business. I got $1 million, $10 million profit. How are we going to shield this thing? Those are all different conversations to have. And we have those conversations, on a regular basis. But, it's about meeting the investor where they're at and fixing a problem for them. And it's really what syndicators should look at themselves as. You mentioned, there's some syndicators, there's some folks out there that, there's some deals that get structured that are fee heavy. That's often what you see in Wall Street. If you tear apart those deals, almost all those deals are fee based. It's not like if you win, then we win. It's like fee based. It's like we collect our fees and, whatever happens after that happens. But no, this is about, finding the deal, putting it, and solving problems for your investors. Syndicators that's the number one question they should be asking themselves. How can I solve a problem for my investor?
Dave, what are maybe 3 of your biggest lessons or learnings working with investors that's made you a better steward of their capital? You've been doing this for a while, and so I imagine the mindset that you started with, you've learned along the way, and you're here now. So what's maybe changed along the way that's made you better?
Yeah, so that's a good question. I will tell you, I take investors' capital much more serious than I do my own. If I lose my own money, I can sleep at night, and I'll make it up on the next one. If I lose an investor's money, that keeps me awake at night. So you don't want to go there. And diligence is a big part of that. Being able to, do diligence and make sure that, look under the hood and if they're audited by third parties, that's kind of the gold standard. If you can get, audited financials, great. That's not always possible, in the realm that most syndicators play in, where you're dealing with an operator and they're not all fully audited. And there is a trade-off. If you want to invest like an institution and you want the fully audited financials and all that, and you want to settle for 3 to 5% ROI or 7% ROI. Okay. But many times when you're dealing with a smaller operator that's closer to the deal and, they're operating lean and mean, many times, you don't get fully audited by one of the top 4 firms in the country. And, so that's kind of a trade-off. You want the margin or you want to deal with, want the kind of returns that institutions are used to getting. So it is a trade-off, but I'd say diligence and get to know your operators and get to know their investors and talk to people who've done business with them for a long time. Those are all ways that you can reduce the risk for your investors.
Has that been your primary focus? First you launched your first fund. What was your first fund that you syndicated?
The first one that I did with scale was multifamily apartments. I got into the multifamily apartment space, built up a portfolio of 3,000 to 4,000 doors. I was totally out by 2022, sold everything. And then, transitioned into self-storage. Actually, I started transitioning into self-storage while I still had a bunch of multifamily, but really kind of transitioned from multifamily to self-storage.
And from there, I mean, I guess what I'm trying to dig into is it that this recurring theme of, hey, I wanted to add self-storage to my portfolio and that's why I transitioned? Or were there things that you noticed in that asset class that maybe, as you went and moved on to others like self-storage that, were good for all those who invested with you?
One of the things that attracted me to self-storage, I started getting really interested in self-storage in 2017. I just felt like we were getting closer to the top of the market cycle than we were to the bottom. And during the research that I did, I recognized that self-storage typically did very well in times of stress and distress and when things weren't going so well. And then when you look at, look, when you study the space and you look back at 2008 to 2010, self-storage was the best performing asset class in all of its commercial real estate peers. It was least affected on the downside and most affected on the upside, going into and coming out of 2008 to 2010. When you look at what happened in 2020 to 2022, it was number 2 behind data centers. And so, you just realize that self-storage is sort of a hedge in your portfolio. When things aren't going well, that's when you want to own self-storage. And so it was sort of market. I don't know if it was market. It wasn't really market timing, but I kind of, I felt like, we were closer to the top of the market. It felt a little frothy to me. Obviously, I left some meat on the bone. I started selling in 2019. I should have held for another year or two before I really started selling a lot. But look, we made some money and it's all good.
Yeah. Dave, thank you so much for joining us today. This was incredible to have you. Where can people go find you?
So our website is therealassetinvestor.com. And if any one of your listeners reaches out to my team at info@therealassetinvestor.com, we will reach out to them. We will have a conversation.
Cool. Thank you so much, Dave.
You got it. I enjoyed it. Thanks for having me on your show.
All right, now I have some final thoughts for our listeners. There are over 350 of you who are already on my email list. But if you are not already, if you'd like access to our database of private placement opportunities that we see every week and get a first look at the opportunities that we're putting together at Grow Your Cashflow, you can join our investment club at growyourcashflow.io. Now, if you found this helpful, don't forget to share it with your friends who might benefit from this particular episode as well. And lastly, if you have any questions, suggestions, or just loved a particular episode, reach out to me on Twitter. Thanks for joining us, and I will see you on the next show.